the background and context of the deal, such as why First Republic Bank failed, how JPMorgan Chase led a consortium of banks to provide a lifeline to First Republic, and how the FDIC invited bids for a post-resolution takeover. First Republic Bank was a San Francisco-based regional bank that catered to high-net-worth clients, offering personalized service and competitive rates. However, the bank had a major vulnerability. Nearly two-thirds of its deposits were uninsured, meaning they exceeded the $250,000 limit covered by the Federal Deposit Insurance Corporation, FDIC. This became a problem when two other large regional banks, Silicon Valley Bank and Signature Bank, collapsed in March 2023 due to liquidity issues and exposure to cryptocurrency losses. These failures sparked a panic among customers of First Republic, who feared losing their money if the bank also went under. As a result, First Republic experienced a massive run on deposits, losing 41% of its deposits in the first quarter of 2023. To prevent another bank failure that could destabilize the financial system, the federal government intervened and arranged a bailout for First Republic. On March 16, 2023, a consortium of 11 major U.S. banks, led by JPMorgan Chase, injected $30 billion in uninsured deposits into First Republic with the backing of the FDIC. This was meant to buy time for First Republic to find a buyer or merge with another bank. However, no suitable deal materialized in the following weeks, as potential buyers were deterred by First Republic's deteriorating financial condition and legal liabilities. On April 24, 2023, First Republic reported a dismal earnings report that showed it was still bleeding deposits and losing money. The bank's stock price plunged to an all-time low of $8 per share, down from $160 in early March. With no other option left, the FDIC seized First Republic on May 1, 2023, and sold most of its business to JPMorgan Chase for $2.7 billion. JPMorgan Chase acquired $103.9 billion in deposits and $229.1 billion in assets from First Republic, as well as 84 branches in 8 states. The FDIC also agreed to cover any losses on $145 billion of First Republic's assets. The deal was a win-win for both parties. JPMorgan Chase expanded its customer base and geographic footprint, while First Republic's customers had uninterrupted service and their funds were safe, even their uninsured deposits. The FDIC also avoided paying out billions of dollars in insurance claims to First Republic's depositors. The takeover of First Republic by JPMorgan Chase marked the end of an era for one of the most successful regional banks in the U.S., as well as the second largest bank failure in U.S. history after Washington Mutual in 2008. It also raised questions about the risks and regulations of regional banking, especially in the wake of the interest rate hikes and cryptocurrency volatility that contributed to the collapse of several banks in 2023.